So it looks like stocks will never go down again. Even on a little buy the dip, a dip we had the last couple of days, it turned into a buy the dip scenario. So, now that, are there some signs out there that are suggesting that we'll never go down again? Are there some signs suggesting we might not go up as much as we think we will? So I'm going to break that down in today's video and kind of show you what the technical signs are out there and how they've kind of been evolving over the past few days, what our potential is over the short term, what my expectations are at least, and how we're going to handle that, and how we're going to handle if it doesn't perform as I expect. And that's going to be actually what we talk about with our trade idea of the day. So let's go ahead and get started. Today is Wednesday, April the 22nd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You'll notice that here we had a nice little update, a little bounce back, gapping up, and then starting to fill in yesterday's gap that we had. Intermediate posture still strongly bullish. The near-term line had dipped, but is still in the lower reversal or lower half of the chart. Did not dip into the lower reversal zone after pretty much two straight days of extreme lows. Didn't quite get as low yesterday, but a couple of straight days here of pretty extreme momentum lows, which can be a red flag in terms of trend changes. So keep that in mind. But regardless, the trend has not changed as of now, and this would be a bullish near-term low point. It'd be slightly lower than the last near-term low point. There's the last near-term low we got. It actually was a little slightly lower, and this wouldn't be a near-term high point yet because we don't have the near-term line bouncing above 50. So, but if really, the last significant near-term low point would be this one. I mean, that was kind of a brief little dip, and we got that bearish divergence. The concern is we got that bearish divergence, lower highs. We broke through the divergent low point in between, which typically also signifies change in trend. So a couple of red flags for change in trends that obviously has not happened yet, but keep that in mind. Depending upon whether we get to new highs or not. If you take a look at the Russell 2000, which when you look over here and you can see the Nasdaq 100 was the top performing asset class on this list. And then on the other end of the spectrum, you see, or you look for the small caps, and there's the small caps index. So big difference there between the Nasdaq 100 and small cap stocks. We're going to talk a little bit about, there's mid caps right above it. So I'm going to talk a little bit about that here when we get to the later part of the video. But just to kind of show you that we're still not really getting broad participation here. We're still bearish, and we're kind of got a little bit of a triangle forming here. The intermediate posture is rising, so we've got light green, but we're not anywhere close to a green line yet. And we're not above 50, so we don't have the dark green shading, and this didn't have a bearish divergence because we actually did get a lower near-term high. But we got a bullish near-term low there. That was a little bit more significant than what we saw in the S&P. And then we're getting another near-term low now. So we're essentially coiling here. The question is, where are we going to come out of this coil? Now, typically, we come out of a coil in the same direction we come into it. So it's a good expectation, a good chance that we come out of it on the bullish side of things. You take a look at the Nasdaq composite, and again, you can see why we're so bullish. It's the only index average here, major average, that has the intermediate line up above 80. The S&P was close, right? Yeah, the S&P was close. The Dow's not as close. And then you can see where the Nasdaq composite is. Getting a bullish near-term low point on the Nasdaq composite. We didn't have nearly as big of a drop. So this would be a much higher low point coming down from a much higher high point. So we've got a strong near-term trend that potentially can bounce back up. In fact, we closed above yesterday's high point. Yesterday's high was 84.80. We closed at 84.95. So, I mean, there are some signs here that we can be really bullish coming out of this. Whether you believe that's rational or not, the reality is there's some bearish signs, but there's also some kind of other signs that we were getting some divergent signs on this high point. the question is whether or not like that's a near-term low point, and how, you know, I mean, of all the signals, I mean, that's just a that's probably the weakest one, the momentum, because it's the shortest time frame. Longer time frame, stronger signals, there's fewer of them. Shorter time frames, more signals, but less reliable, right? So keep that in mind there, and you know, again, you know, a positive sign that we can just keep on trucking. And if we keep on trucking with such a small amount of stocks leading the way, then we can ride that trend as long as those stocks take us. But we just have to be prepared for when they can't take us any further and what happens. And we already saw a precursor of that over here. You know, it was a coronavirus and pretty much a global shutdown that made it so significant. It might not be 30%, like I said before. It might not be 30% in 4 weeks. It might be 30% in, you know, 9-10 months. Once those few names can't lead us up anymore, simply potentially for the sake of they're just too high of a valuation now to attract you know, long-term investors. There are people more short-term in nature, and they tend to be weaker hands than the longer-term investors. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below our video, down here actually. That will notify you when these videos are posted. Also, while you're down there, click that thumbs up icon. That tells us two things. Number one, you liked our video today. Number two, you want us to do another one tomorrow. It's a quick way to give us feedback. If you like our videos, you want us to do them again, click that thumbs up. If you don't have to click on anything. That's the nice thing about that simple survey. Like I said, you can do that right now while you're watching. Also, while you're down there, and anything that stands out to you while you're watching, comment on it. Let us know anything that stands out to you, or what you got out of it, or any questions or comments you have on our video today. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created. If you watch here on our blog, I also invite you to check some of this other stuff out, including our Market Outlook live video, where we go through all of our Market Outlook trades that I do in my videos. We manage them all the way to the close. We manage them as part of a class portfolio with trades that we make in other of our classes. So it's a very popular segment. Brings a lot of people to. We get a lot of people in that from day to day. It was highly requested. So if that's something that interests you, you actually get access to that as part of your monthly subscription, as well as access to all 8 of our trading rooms that we do throughout the week. 4 by myself, 4 by Brandon. Our premium subscribers get access to all of that, plus other stuff, including these Q&A sessions that you can see. Our next class is tomorrow morning, Brandon's Q&A session there. We also invite you to engage with us on social media. Hit this heart. It opens up a new window. You can click that like button, hit the thumbs up icon. You can do the same thing on Facebook. Again, that benefits us because the more likes our content gets, the more those platforms will push it out to all of our followers. It benefits you because Twitter will promote content to you from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here so you can get our content. All right, if we take a look now at the long-term chart, you can see how this candle's really shortening up, even with a little bit of a rally here today. So again, the high 28.68, we're at 2800 essentially right now, 27.99. The midpoint of next week's candle is going to be right around 27.65. So depending upon where we finish, it's only 30 points away. We might end up, again, it's going to be how we finish this week and where do we finish the week in relation to where the midpoint of this bullish candle. The further away we get from it, the closer we get to the high on an actual close, then the more likely we'll, depending upon how we open up Sunday night, the more likely we'll end up with some, again, it doesn't have to be a big bullish body, but just a bullish body. But the more likely we end up finishing right around the midpoint of this, the more likely we can get, again, next week's open will be right there too, and then we'll have a really small body. And again, small bodies coming off of these kind of bullish candles can be reversals. As we see these reversal candles here, they can be reversal patterns. And so, that's the issue, right? When you go back, a little bit further, there's the smaller body that came after that nice little rally that we had, just short-term rally. But again, you go back to a longer term view than that, Go back to 2008, of course. The last time we had any kind of significant selling like this, we had a little bit of bullishness, and then you can see that next week at the 50-day moving average, we rolled right over, and we had a little bit of a small candle there too. So, you know, we weren't nearly as bullish on these candles as we are now. We weren't as far down like back then as we are now. So we rallied we've come up pretty sharply to get from, we were way below that 50-day moving average. So we've sharpened that up really quickly. And so now it's like, okay, we're not really going anywhere. There's that long-term trend line we've talked about before. We're sitting right at that long-term trend line for a resistance level. We're sitting right at the 50-day, and we're unable to really get through it very well and maintain it. So let's keep an eye here in the next 2 days to see how well we finish there. If you take a look, I mean, obviously it'd be more bullish if we finished up at the highs of the week. It'd be less bullish and might be reversal conditions if we end up closing a little bit lower than 30 points lower than where we're at right now, which obviously would be about a 1-2% drop to the downside. It's not very far away. You take a look at the 3 green arrow chart. Not surprising to see that we still have 3 green arrows, but man, we are really close to losing that momentum, the positive momentum on the MACD. You can see that MACD is still barely above its moving average, and the stochastics is below its moving average. Now it's still up above here 80, so it's not it's not too bearish like over here or even over here where it just dips slightly below 80. But the difference here is when you get these crossovers of the moving average when you're bullish, they don't really have nearly the same impact as a crossover on the moving average when you're not so bullish. Again, we don't really have a whole lot of bearish trends to be able to look to because we haven't been in the bearish trend for a long time. But if you go back, let's go back a few years to like some of these areas, you can see when you crossed over, when you were in a bearish trend, we crossed over, we went down. And same thing over here, when you crossed over the moving average over here. Now these were lower, they didn't get in the reversal zone, but you can see they crossed over. Whereas some of these bearish crossovers up here, we just maintain trends. And of course you go back even further to try to get more of an extended in some of these areas here. This one, the moving average didn't quite get in the reversal zone, we rolled right over. You can see this one did, and we rolled over and we came right down, and of course that one was well below, and that was in 2015. And you can see we just haven't had periods of bearishness, extended periods of bearishness. Here's one where we were on a lower high point when we got it, and it was and we didn't stick around, right? See this, we got lots of bearish crossovers, we continued to trend higher. This one, it was a lower high and we rolled right over from that. Here's a 2011, same thing, lower high point, we rolled right over from that after that crossover at that point, and we finally started getting going, but even that one was relatively bearish, and that was a higher high point. We got a decent crossover, and of course if we go all the way back further to the 2008 time frame, so way over here. So right, again, looking at bearish moves, there's a bearish crossover, and we were pretty bullish there in 2007. At the end of 2007, we got the death cross right there, but that was a pretty bearish rollover from a lower high point. And then here is 2008, so here's the end of 2008. Again, lower high point, rolled right over. Some significantly lower high points, you can see the rollovers from these. So that's, I'm not looking for this type of rollover now because we're not in a bullish trend right now. We are in this bearish trend. So even if we don't go to lower lows, right, from this lower high point, the fact that it's going to be hard to just kind of grind up through some ups and downs, because that's not the type of market we're in right now. That's a nice, good long-term bullish trend. This is just a move off of an extreme low point on a pretty significant bearish move that we saw. All right, now let's take a look at the intraday chart, and you can see, we talked today, this is the gap. This is the top of that gap, of that runaway gap now, and that's going to come off of the table here. So you can see in just a couple of days, this is going to be the low point, and that's still a 40-point move. That's still about a 15% band here, 4-week band. That's a high band. In our class today, my options class I taught today, I talked about how wide the bands typically get, and 5% when you're kind of just grinding in a bullish range, 10% when it kind of expands out after a big move to the downside. Well, obviously we had a big 30 some odd percent expand out, so we're expanded up, but we're still, this band is tightening, and it's got room to tighten without necessarily going up to higher highs or coming down to lower lows, because it's still, even as it gets even up to this level, after we get through these days and the new low point, barring any new ones that we create over here, and if this ends up being a new low, that's still 256, 257. That's still a 30 point. That's still more than a 10% range off of that high point. That's still a very wide band. We won't really tighten up significantly until we get to this level, 271, where it's a 14-point range. And now there's your 5% band, which is typically how wide it gets at the, when you're nice grinding higher in a bullish trend. So that kind of gives you an idea of just how wide these bands are, and that's going to limit how many more of these high tags we get, because the reason why we stretched out this much now on the bullish side is because it was so stretched on the bearish side. The bearish move is what widened it out, and we just filled in the gap. We filled in that gap. Remember, the high was way over here. The high point was over there, and we got to the high point before it moved down, right? The high point never moved down to these lows. If I were to go out a little bit further, the high point here moved, it got about down to like this level by the time we had moved the 4-week lows down. So we never really moved it down. It was way here. We pushed down to this low point while the high was still up in this area, and then we made this new high. So we never really got down to a smaller range that we could push up, because it never pushed that. I mean, I think that actually made, if this didn't make the high point here, this one did, and then that's it. And then we really haven't pushed to new highs since then, and I don't think we really will push to new highs now anytime soon, at least significant new highs, because like I said, that rubber band is stretched. You stretch it out more, it's stretched because it was stretched with a bearish move. It's hard to, fill in that stretch on the bullish side and keep stretching it with a bullish move. You just got to tighten up first before you can stretch it back out again with a bullish move to the upside. So that's kind of, I expect us to, at best, kind of stay in this area here for the next week or two while this low point comes up. At worst, we fill in this gap right here, and that's kind of what we're watching for on any kind of significant bearish move, to fill in that gap that I still think is not a runaway gap, because the runaway gap is below this low point from before. So, because that had this significant bounce in volume, that one didn't. See, no significant volume there. So that's kind of what I'm watching. And again, volume gaps get filled just like price gaps do. So there's still that volume gap here below where we are right now because of how fast we moved up. I mean, from this point here, from 247 to 287, there's a 40-point move, and a big chunk of that move occurred overnight. So, I mean, shoot, the first 10 points of it occurred overnight. So out of the rest of the 30 points, again, a good chunk of that occurred overnight. So not a lot of volume. There's not a lot of volume to begin with anyway, just in the regular trading session. So there's really not a lot of volume on the upward move, right? So a lot of the gains just haven't occurred during the regular trading session. All right, now let's take a look at the volatility index, the VIX. Well, first of all, see the range, what the range today looked like. Very tight, but remember you have to include the gap, as the ATR includes that gap. So we closed 273.04. The low was 276.90, so almost a 4-point move. About, let's see, 273. So about a 4-point move that we need to add to the daily range. So about an 8-point range, just a little bit below the average. The volume was way below the average, so extremely light volume. I mean, that volume is really tapered off significantly. I mean, again, just to kind of give you some examples of how this is tapered. Do I get to 208.09 here? Yeah, I do. So to kind of give you some examples of how we've tapered like this in the past after these big moves. So there's 18. We came down, but you notice we came back up on retests of average volume. And then we got the big move, the exacerbated move to the down, the blow off type bottom. On this move here in 18, we had the big move up, and then we had the retest of another kind of big average volume move. We popped up a couple of times and retested with those volumes. We didn't stay we didn't stay down this whole time. And of course, going back out to like 2011, big surge in volume, big move, lots of arrows, pop, 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 coming down below average, not nearly as below average we are now, kind of stayed around the average. But then you can see how we popped up to average on the retest, right? There's the low point, then there's the retest of the low point, and we bounce back up. And then of course the big example that everyone uses, the big surge in volume, all the arrows, that was actually in September, but then there's the big one in October. And you can see again, we didn't fall too far below the average. We kind of hung around, and then there's our retest with the big jump in volume back up to 2 times and back to the average volume there. And then there's our retest of the March low point with some above average volume. But just to kind of show, we didn't fall off this sharply below the volume level here. So again, another kind of red flag. We kind of stayed up around here, like where my cursor would be in this area, and then the retest brought us up. So now the average is dropping so sharply, the retest is going to be with some above average volume potentially. So keep that in mind. A bounce in volume here is not going to be, sorry about that, a bounce in volume here is not going to be above average, right? It's not going to get us to above average volume. If I take a look here at the trading range, here we go, and the volume here, you can see 93 million is way down here, so it's still bringing that line down. The 8 points just a little bit below the average, and it's still about the 3 point mark. So again, remember the average, the low point in past moves has occurred after we've fallen to 3%, after we had the big surges, after we've come back down and hit 3%. That's when the significant retests come. Again, we don't have a lot. The sample size is really small because we haven't had surges to of ATR of 6% or higher. But the few that we've had, we haven't had the low point form, the retest, the significant retest form, until after that. Again, 0809, big common example here, because even like 2000 and there's 0809, even 2011 didn't get us up above 3%. It got us up to 3% and used that as the resistance. And then the same thing in 2018, we got the 2%. All these others were 2%. And then we got it briefly above 2%, but didn't get above 3%. So our examples aren't very much, but you see how the retest didn't occur. I mean, even this retest occurred while we were still really, really high. And then we had the March retest after we had come down to 3%, right? And we had a little bit of a bounce. So that's, don't just because we're getting closer to 3% doesn't mean that we are out of the woods of a retest, because they occur after that, not before. Sometimes a little bit of one while we're up here, and obviously that didn't happen. And now, there's more likely we'll get one that's more sustained, not like, like we're going to go to 100s, that kind of sustained, but more like we'll get back down towards these lows over a lot longer period of time because the ATRs will be a lot smaller. All right, the other red flag too that says, we're not, that this little pullback is coming is this volatility is still in the 40s, right? We're not, it's one thing to stay in the 40s with this dropping down because the back month is so high and this is settling down, but it's not. Our volatility is still staying up above 100%. We're not even coming down to 95%. And we did that in 2008, 2009, right? So if you go all the way back to that one, here when we came down in 2008, you'll see in this level of 2008, so there's the November retest. We hadn't come down before the November retest. Before we got the March, we came down to 95%. So that's, you can see, we've seen in the past this kind of surge, and we're still holding. Even over here in 2018, early 2018, when we had that big surge, we came down below 100% and tested the 95% mark. We even came down to the lower end briefly before we had that March 18 retest. Over here, in the end of 18, we tested the 95% mark. We're still holding up at the 100% mark. There's still a lot of uncertainty out there. So we're not out of the woods yet, according to all these technical signs. All right, so before I look at these intermarket relationships and our trade idea of the day, just to summarize our technical outlook, we're obviously been bullish. There's been some red flags showing up here, especially here more recently, that suggests that while it looks like we'll never go back down again, we are seeing signs that we haven't seen. Like we haven't seen the technical signs yet that are associated with the low points on these extreme drops like we've seen in the past. So there's still some things that need to be shaken out. So now, that doesn't mean necessarily that we'll drop as hard as we dropped before. And I think that's in a binary market world where everybody thinks we're either shooting to the moon or we're heading towards zero. The reality is always somewhere in the middle, right? So we're not going to drop again like we did. We're not going to have a 34% drop in 4 weeks again. But, we can still, the signs suggest that we can still move towards those old low points at a much different pace than what we saw before. And for some people, that might be more uncomfortable to grind, because the bigger moves pop back up really quickly. It's the slower moves that's harder to bounce back as quickly from, the slower downward moves, the downward trends. So those can be a lot more painful. And not that I expect us to be in a bear market type 2007, 2008 move yet, at least, off of this particular low point. I do think that it's going to be frustrating that we're not bouncing as fast, because I think a lot of people are kind of start getting suckered in. We're going to make a bullish trade today in case the market does V-bottom and just go up to new highs. And the more and more, just to have something, right? I'm still bearish. I still expect that we'll pull down towards these lows, and I got plenty of bearish trades to take advantage of that. But I'm not one-sided either, right? And so we're going to talk about today. So to avoid being one-sided, what are the bullish trades that we want to make? And we're going to do an example today of that. So to kind of show you what I'm talking about with staying balanced in this type of really volatile market, it's really important to stay balanced. So what do you think? Do you agree with that technical assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing differently? That would suggest either you're a lot more bullish, or you think that you're a lot more bearish. You think that we've got a lot more selling, a lot faster selling yet to come. Usually, as we come back to the charts here, usually, if I have an opinion that will retest the low point, it was a popular opinion. Everybody and their dog was talking about it. Whenever you have an expectation in the market that the market will do something, unless you're like slowly trending, the expectation of what you're looking for, if it's the popular thought, there's a good chance it's not going to happen yet. In fact, the more unpopular it gets. So that's why I was going to say it's probably pretty unpopular. There's probably not a whole lot of people that are expecting a more bearish move than I'm thinking, or even as bearish a move as I think will happen. And so the more unpopular it is, the better I feel about it, because that's how the market works, right? It tends to move in unpopular ways, unexpected ways, not necessarily in the expected ways, unless it's on a slow grinding trend. All right, now let's take a look. This is something I wanted to show you. So this chart here, this is let's do this one first. All right, this is actually not first. This is the one I wanted to do. This is a comparison chart of the QQQs in purple since the January 26, 2018. Remember, that's where I say that we started the bear market that really got going in October of 18, because commodities lagged and they peaked last in October of 18. Small caps peaked here too. But really, from an international standpoint, we started in January of 18. We've been in the bear market since. Well, this line here is a line chart in the comparison of this equal weighted. This is what Josh Brown brought up today. This equal weighted ETF. So this is large and mid cap stocks that are kind of put together. So about 600. So it represents about 85% of the market cap in the US. And it's equally weighted every quarter. So it's not always equally weighted, depending upon the moves within the quarter, which we've really had a move here it can be unequally weighted, and it's pretty unequally weighted right now towards like Regeneron and stocks like that have done really well, and unequally weighted on the downside against the stocks that have pulled back the most. But the idea is, if you notice, since that January 2018 peak, because that was a peak, we dropped off. That's the first quarter of 2018 drop. That's the fourth quarter, and then of course you can see how those two pale in comparison to what we just barely had in terms of extent. But you notice that since that peak, the QQQs have really outperformed. So at this point in October, or in this case September of 2018, we were just barely getting to new highs in the equally weighted index. But the QQQs were almost 10% higher. And then we pulled back, and you can see QQQs really pulled back quite a bit relative to the equal weighted, so the gap really shrunk. But off of that low point, the QQQs led the way higher. In the early part of 2019, the gap shrunk again on the pullback, and then the gap got bigger here. You can see the gaps getting bigger and smaller, and then we had the pullback, and then the gap really got big here to the point where from this peak, the QQQs were up almost 40%, 38%, and this was only up 12. So big time, 3 times the performance from these 100 companies that are market cap weighted too. So really towards a handful of stocks, whereas this one is equally weighted. It was still higher, 12%, but not nearly as high. I mean, you can see once the selling really started, we were already negative. Just right there, it had already gotten negative, and at that point, we're still a 20% gain off of those January peaks. And of course, once the selling really kicked in, we were down 30% from that January 2016 high. At the worst, the Qs were at break even from that January 2018 high point, excuse me. So that kind of shows you the type of markets that we're in from an equally weighted standpoint versus a large cap. And you remember, our economy is consumer driven. It's also small business driven. So, I mean, yes, it's great to have some large cap stocks lead the way, and great. But the reality is the economy does better when all the smaller companies do great too. And when they're not doing great and only a handful are. We've seen this story before. It was that way in 99 and 2000. It's that way now. It was that way at the beginning of the year when that gap really kind of blown out. And remember, the gap's gotten bigger during the pullback. So the gap that we saw here has gotten even, because that was only a 38 to 12. It was a 26% difference. Here it was break even to 30, 31, 32. So the gap has gotten bigger, and it's, remember, the relationship, that relationship I showed you, the relative strength has gone parabolic between Qs and the small cap index, the Russell 2000. So and even now here, you're at 23% gain on the bounce back. The gap has gotten even bigger. So we're at 23% gain with a 15% drop. That's a 38 percentage point gap difference. So that's a wide gap that you know, you can see in the past, the wider the gap, that when the gap closed, it wasn't with the small caps or the equal weighted rising up to catch up. It was with the purple line dropping during pullbacks to catch down. And so I don't know when or if that's going to happen, but that's what we've seen in the past, and if we see that again in the future, I mean, it's, you know, if the small caps catch up to this, then you know the valuation ratios are going to blow through the moon, like a la 1999. And so but if this catches down to that, then that will create the value creation and the long-term return potentials and all of these stocks, including these large caps, that we're just not getting right now. There's not good long-term return potential in these big large cap names because they're so highly, they never dropped as much. I mean, again, break even from that level. So they never really dropped to 30% that we can say, okay, let's pile into these areas because now they've got long-term, you know, good 1, 2, 3 year return potentials going forward from here. I also wanted to bring up the foreign market comparison. So I want to bring up this 12 grid here on the 12 biggest economies that are out there, and you notice lots of dark green shading, some light green shading, but you notice no green lines. They're all yellow. and one of them still red, and one of them just barely yellow. So we're not like, from a broad market in terms of international market standpoint, it's looking like it's kind of a sucker move. Like, look how bullish we are, and the reality is we're just not that bullish yet, as nearly as bullish as we think we are. And of course, if I change this to Russell 2000, it's not nearly as bullish as what we saw. It's light green shading like all the rest of these, like Italy, like India, like Brazil, which have really been lagging behind, unlike some of these others. Even China initially had some outperformance, but has really slowed down after that initial burst off of the low points. Let's take a look now at the sector chart. So this is interesting. Now, these are all dark green. So you think, man, we are really bullish. And again, only one of these has a green line, right? And that's the healthcare sector. All the rest of these sectors, now some are close, technology is close, discretionary is really close, communication service is getting pretty close. The rest of these, not so close. And the intermediate lines are just barely above 50. These are pretty high. These are above 80. This one's at 77. Of course, healthcare is 92. Staples is above 80. But the rest of these are in the 50s. Energy, industrials, financials, materials is in the 60s. These are the economic sensitive areas, and they're just not doing very well. In fact, if you just look at today alone, sector comparison, sector comparison, and we just look at just today alone here, so April 22nd, and we'll go to a 10-minute chart. Again, energy had an okay day today. Started off really well, ended up pretty decent. There's technology and communication services, but look at industrials and financials, and staples for that matter, but industrials and financials, healthcare, not too surprising, giving back some of its gains. But, I mean, these are economic growth sensitive areas that are really lagging behind. Materials also lagging behind. So that's not necessarily the best sign. I mean, it's nice to see technology, communication services, discretionary lead. You want those to lead. But you also want financials and industrials above that black line too. And you want utilities below it, and real estate. And you want energy and materials at least matching it, if not trading a little bit above or a little bit below. But, I mean, we're not even matching it. I mean, the good move at the end of the day for materials, probably from those gold stocks. But they're not matching. They're not even matching. And so, and of course, energy had a good day today. But, the reason why it's had such a good day today is because here's the move off of the low point so far that we've had. It's, look at that big run. It's had 42%. It was so bullish that it's just had some really strong bullish momentum. But then there's healthcare, there's utilities and real estate. Look at the gap between those and the broad market as a whole. And then down here at the bottom, you still have industrials and financials lagging behind along, in this case, still with technology and still with communication services. Their run recently hasn't been strong enough yet to get them to outperform off of that low point. All right, so in our classes, we talk a lot about balance, especially in this type of market. When you're in a strong bullish trending market, you can be unbalanced towards the bullish side. It's easier to be a little unbalanced towards the bullish side because you're in a bullish trend, and bullish trends last longer, as I've shown you before. But these bearish moves, they're harder until we fail at the 200-day moving average and we start to trend to the downside. It's hard to be unbalanced to the bearish side. It's important to be balanced. We've made plenty of bearish trades in this particular video to be able to take advantage of any kind of pullback that we're getting, and we will continue in our classes. I'll continue, but if we continue to move up and we know what's leading us up, then we need to be prepared for that too, right? We can't be so one-sided that if the market keeps going up and up and up and up and causing pain for people who are unbalanced to the downside or still in cash waiting for the pullback, then we never take advantage. So we've had some bullish trade examples as well in our classes, and we did a few recently, but I want to do another one here today, specifically in Autodesk. Take a look at ADSK. You can see, it's got dark green shading and a green line. Its intermediate line just barely turning up above 80. It's still not as strongly bullish on a near-term basis, but again, nothing is right now, right? We're not getting the strong moves. It had a good near-term run above 50 to get up to this kind of higher high point here. And so far, the pullback is to a nice bullish level. If you take a look at its 3 green arrow chart, you can see, it's got falling momentum, but still easily hugging the 8-day moving average. And with today's bounce, its stochastics in bullish territory. If you take a look at its Bollinger Bands, you can see we are obviously in the upper half of the bandwidth. We are above a significant volume node. We had broken out a few days ago above the value area, and we pulled back down to that support level, potentially bouncing off of it. And you can see good strong bandwidth level there. If you take a look at the Ichimoku cloud, we are actually through the top of the cloud, and even if we pull back a little bit more, we would still be above the top of the cloud here for a while, with a moderately strong trend above 2, above 65. You take a look at its DMI, and during the pullback here, this short-term pullback, the DMI pulled down, the blue line pulled down to 25, purple line popping up above 20. But you can see previously you had the bullish breakout move where it got above 25 and the negative got below 20. So we're seeing signs, again, I think the broad market as a whole is going to pull down, and if it does, so will this. But if it doesn't, then I need something that will help us on the upside, and this is a stock that's got some good technicals on its own, that if we continue to trend higher here, we know what's leading us higher, and this would be one of them. So to take advantage of that, I want to go to an option here, and we are, like I said, we've already done this in the Market Outlook Live before the market closed. We went out of the money below the 40 delta, and we bought this contract with full normal position size and positioned around the full maximum loss, which now really decreases the odds that I will get stopped out on this trade. If I were to say buy at the money with a 50% stop, then there's a good chance I get stopped out with my stop order. But here, if I position size around the whole thing to lose that full $1,000, then I would have to, it would have to go worthless. So, and we know that more likely I'm not going to ride this thing all the way till it's worthless. If it starts to roll over, we'll get out of it. End up with a $500 loss, a $400 loss. But if worse came worse and we just gap down for whatever reason, then I know I can't lose more than 900. In this case, $940. It looks like we ended up getting at $925 when we initially got into it. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Let's use that link popping out top right corner of your screen. It takes you to our Market Outlook forum on marketscholars.com. You can post any thread, open up any new thread with any questions or comments you have about today's video, reply to other people's comments, and let's keep this conversation going in between the videos. I remember to, again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below, follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created, as well as our community at our website. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.